What if I told you that the financial product your insurance agent is pushing hardest is the one that benefits him the most and hurts you the most? My name is Harry, and today I'm going to expose one of the longest-running financial scams in American history. A scam so well-dressed, so well-marketed, and so deeply embedded in the financial industry that millions of people are paying for it every single month without even realizing they're being robbed. By the end of this video, you're going to understand exactly why whole life insurance exists, who it actually serves, and why the smartest money minds in the world, from Warren Buffett to Dave Ramsey, have been warning people about it for decades. Section: Understanding the product. Before we expose the scam, you need to understand exactly what whole life insurance is, because the way it's sold to you and the way it actually works are two completely different things. So let me break it down in the simplest way possible. Whole life insurance is a type of permanent life insurance that combines two things, a death benefit and a savings component, which the industry likes to call cash value. Your agent will walk into your home, sit across from you at your kitchen table, and paint this beautiful picture of a product that protects your family and builds wealth at the same time. He'll say things like, "This policy covers you for your whole life," and "You're building cash value that you can use later," and "This is how the wealthy protect their money." It sounds incredible. It sounds like the perfect financial product. And that's exactly the problem, because what he's describing and what you're actually getting are two very different realities. Here's the basic structure. Every single month, you pay a premium. That premium is significantly, and I mean significantly, higher than what you would pay for a simple term life insurance policy with the same death benefit. We're talking anywhere from 5 to 15 times more expensive. And where does all that extra money go? Your agent will tell you it goes into your cash value account, where it grows over time. But what he won't tell you is how slowly it grows, how many fees are eating into it, and what actually happens to that cash value when you die. Section: The cash value trap. Now let's talk about the biggest selling point of whole life insurance, the cash value, because this is where the scam really starts to get ugly. Your agent makes cash value sound like a bonus, like a gift, like free money that's just sitting there growing for you. But when you pull back the curtain and look at the actual numbers, the picture becomes very, very different. First, let's talk about growth. The average whole life insurance policy grows its cash value at somewhere between 1% and 3.5% annually. That's it. In a world where the S&P 500 has delivered an average annual return of around 10% over the last 50 years, your whole life insurance cash value is crawling, barely keeping up with inflation, and in many cases, not even doing that. Your agent will dress this up by calling it guaranteed growth and safe returns. But what he's really describing is one of the slowest, most inefficient ways to grow your money that exists in modern finance. Second, and this is the part that makes financial experts genuinely angry, in most whole life insurance policies, when you die, your beneficiaries receive only the death benefit. Not the death benefit plus the cash value, just the death benefit. So all those years of cash value you were told you were building, the insurance company keeps it. Every single penny of it. You spent decades contributing to this account, watching it grow, thinking it was yours, and the moment you die, the insurance company quietly pockets it and pays your family only the face value of the policy. Section: Follow the money. Now here's the question you should always ask when someone is selling you a financial product. Who benefits the most from this transaction? Because once you follow the money, everything becomes crystal clear. And in the case of whole life insurance, the answer is painfully obvious. Your agent benefits. The insurance company benefits. And you? You're left holding the bag. Let me give you the numbers because the numbers don't lie. When an insurance agent sells you a whole life insurance policy, he earns a commission. Now with term life insurance, that commission is typically somewhere around 30% to 40% of your first year's premium. That's already decent money. But with whole life insurance, that commission jumps to anywhere between 70% and 120% of your entire first year's premium, sometimes even more. That means if you're paying $300 a month for your whole life policy, your agent is potentially walking away with $2,500 to $3,600 in commission just from your first year alone. And that's before the renewal commissions he continues earning every single year you keep that policy. This is why your agent is so passionate about whole life insurance. This is why he calls you back so quickly. This is why he has a beautifully prepared presentation with charts and graphs and emotional stories about protecting your family. It's not because whole life insurance is the best product for you. It's because whole life insurance is the best product for him. The entire sales structure of the life insurance industry is built in a way that financially rewards agents for selling you the most expensive, most complex, and most profitable product on the shelf. And that product is always, without exception, whole life insurance. Section: the fancy repackaging. Now, the insurance industry is smart. They know that people are waking up. They know that the internet exists and that more and more consumers are doing their research before buying financial products. So they did what every industry does when their product starts getting a bad reputation. They rebranded it. They dressed it up in new language, gave it a sophisticated name, and started marketing it to a completely different audience. And that rebranded version is called infinite banking. If you've spent any time on YouTube or Instagram or TikTok in the personal finance space, you've almost certainly come across infinite banking. It sounds revolutionary. It sounds like a secret that the wealthy have been using for generations that nobody wants you to know about. The pitch goes something like this. Instead of borrowing money from a bank and paying them interest, you borrow money from your own whole life insurance policy and pay yourself back with interest. You become your own bank. You break free from the traditional financial system. You build generational wealth on your own terms. And honestly, on the surface, it sounds brilliant. It sounds empowering. It sounds like exactly the kind of financial freedom content that gets millions of views, which is exactly why it gets millions of views. But here's the truth that none of those infinite banking coaches and influencers want you to understand. The foundation of infinite banking is still whole life insurance. Every single problem we just talked about, the slow growth, the massive commissions, the fees, the cash value that disappears when you die, all of those problems still exist inside an infinite banking policy. They didn't fix the product. They just gave it a better marketing strategy. Section: the hidden price tag. So far we've talked about low returns, vanishing cash value, and sky-high agent commissions. But there's another layer to this scam that almost nobody talks about, and that's the real, total cost of owning a whole life insurance policy over your lifetime. Because when you actually sit down and run the numbers, the true cost of this product is absolutely staggering. Let's build a real example. Let's say you're a healthy 30-year-old and your agent sells you a whole life insurance policy with a $500,000 death benefit. Your monthly premium is $400. That sounds manageable, right? $400 a month doesn't sound like the end of the world. But let's follow that number across your lifetime. $400 a month is $4,800 a year. Over 30 years, that's $144,000 in total premiums paid. Over 40 years, if you keep the policy until you're 70, that number climbs to $192,000. Nearly $200,000 out of your pocket for a $500,000 death benefit that your insurance company was always going to have to pay eventually anyway, because unlike term insurance, whole life never expires. But here's where it gets truly painful. Let's talk about opportunity cost, because this is the number your agent will never, ever put in front of you. What if instead of paying $400 a month into a whole life insurance policy, you bought a $500,000 term life insurance policy for $30 a month, which is completely realistic for a healthy 30-year-old, and invested the remaining $370 every single month into a low-cost index fund tracking the S&P 500? At a conservative average annual return of 8%, after 30 years you would have accumulated approximately $500,000 in invested assets. After 40 years, that number grows to over $1,100,000. More than $1 million. Sitting in your account. Yours to use however you want. Not trapped inside an insurance policy, not subject to surrender charges, not disappearing when you die. Section: when you try to escape. So at this point in the video, maybe you're thinking, okay, I understand, whole life insurance is a bad deal. I'll just cancel my policy and move on. Simple, right? Wrong. Because here's the part of the whole life insurance story that turns a bad financial product into a genuine financial trap, and that's surrender charges. The insurance industry didn't just build a product that takes your money slowly. They built a product that punishes you severely for trying to leave. Here's how surrender charges work. When you first take out a whole life insurance policy, the insurance company immediately pays your agent his massive commission. Remember, up to 120% of your first year's premium. That money doesn't come from nowhere. It comes from you. And because the insurance company has already paid out that commission, they need to recoup that cost before they're willing to let you walk away. So they build a surrender charge schedule directly into your policy contract, buried deep in the fine print that most people never read until it's too late. In the early years of a whole life insurance policy, surrender charges can be absolutely brutal. In year one, if you decide to cancel your policy, you could receive zero cash value back. Nothing. All those premiums you paid, gone. In year two and year three, you might get back a tiny fraction of what you put in. Most whole life insurance policies carry significant surrender charges for anywhere between 10 and 20 years. 20 years. That means for 2 full decades, if you wake up and realize you made a mistake, the financial penalty for correcting that mistake is enormous. The insurance company has essentially built a financial prison around your money, and the exit door comes with a price tag that most people simply cannot afford to pay. Section: The truth about rich people. Now let's address one of the most common arguments your insurance agent will throw at you when you start pushing back. He'll lean forward, lower his voice like he's sharing a secret, and say, "You know, this is actually what wealthy people use to protect and grow their money. The ultra-rich have been using whole life insurance for generations." And this argument is incredibly effective because it sounds credible. It sounds exclusive. It triggers something psychological in all of us, the desire to do what successful people do. But let me break down exactly why this argument is misleading, manipulative, and almost entirely false. Yes, there are some ultra-high net worth individuals and large corporations that use certain types of permanent life insurance as part of a very specific, very complex financial strategy. Banks, for example, use a product called BOLI, bank-owned life insurance, as a tax management tool. Some billionaires use irrevocable life insurance trusts as part of sophisticated estate planning strategies. This is real. This exists. But here is what your agent is conveniently leaving out of that conversation. Those strategies are designed for people with tens of millions of dollars in assets, complex tax situations, and teams of attorneys and financial planners managing every detail. They are not designed for a middle-class family trying to build wealth from scratch. Taking a strategy built for a billionaire and applying it to someone earning $60,000 a year is not smart financial planning. It's a sales tactic dressed up as financial wisdom. The truth about what genuinely wealthy people do with their money is far less glamorous and far more straightforward. They invest consistently in diversified, low-cost index funds. They maximize tax-advantaged accounts like 401(k), S, and Roth IRAs. They buy term life insurance to protect their income during their wealth-building years. They keep their expenses low and their investment costs even lower. Warren Buffett himself has said repeatedly that for most Americans, a simple low-cost S&P 500 index fund will outperform the vast majority of actively managed investment products, and it will absolutely, without question, outperform the cash value growth inside a whole life insurance policy. Section: Dismantling the tax argument. There is one more argument that insurance agents love to pull out when they feel the sale slipping away, and that's the tax argument. Your agent will look you straight in the eye and tell you that whole life insurance offers incredible tax advantages that you simply cannot get anywhere else. He'll talk about tax-free death benefits, tax-deferred cash value growth, and tax-free policy loans. And once again, on the surface, this sounds compelling. Nobody wants to pay more taxes than they have to. So let's take this argument apart piece by piece and expose exactly how misleading it really is. First, the tax-free death benefit. Yes, it's true that life insurance death benefits are generally paid out to beneficiaries income tax-free. But here's what your agent won't tell you. Term life insurance death benefits are also paid out completely tax-free. This is not a unique advantage of whole life insurance. This is a feature of all life insurance products. So when your agent presents tax-free death benefits as a reason to choose whole life over term, he's using a shared feature as if it's an exclusive selling point. That's not financial advice. That's a sales trick. Second, the tax-deferred cash value growth. Yes, the cash value inside your whole life policy grows on a tax-deferred basis, meaning you don't pay taxes on the growth every year. This sounds great until you realize that your 401(k) and your IRA also grow on a tax-deferred or even tax-free basis. And they do it with significantly higher contribution limits, significantly better investment options, and significantly lower fees before you've maxed out every single tax-advantaged retirement account available to you. There is absolutely no logical financial reason to be putting money into a whole life insurance policy for tax benefits. A Roth IRA alone gives you tax-free growth and tax-free withdrawals in retirement, with none of the surrender charges, none of the agent commissions, and none of the restrictions that come with a whole life policy. The tax advantages of whole life insurance are not lies. They're just massively, deliberately overstated compared to the alternatives that already exist for everyday investors. Section: The discipline argument. When every other argument has failed, your insurance agent will fall back on one final justification. And this one is actually the most psychologically clever of all. He'll say, "Look, I understand your concerns, but for a lot of people, whole life insurance works as a forced savings mechanism. It creates financial discipline. Every month that premium comes out automatically, and your cash value grows whether you think about it or not." And honestly, this argument connects with people because it contains a grain of truth. Many people do struggle with saving consistently. Many people do need some kind of automatic system to build wealth. But using that real human challenge to justify an expensive, inefficient product is manipulation, not financial guidance. Here's the truth. If forced automatic savings is what you need, there are a dozen better ways to achieve exactly that without the fees, without the commissions, and without the surrender charges. You can set up automatic contributions to your 401k directly from your paycheck, before the money even hits your bank account. You can automate monthly transfers into a Roth IRA or a low-cost index fund on the exact same day your paycheck arrives. These systems are just as automatic, just as consistent, and just as effortless as a whole life insurance premium. Except the money actually works hard for you instead of sitting in a low-return policy bleeding fees every single year. Discipline is a real need. Whole life insurance is not the solution. Section: The real solution. So now that we've torn apart whole life insurance completely, let's talk about what you should actually do. Because exposing a scam without offering a solution helps nobody. The good news is that the alternative is simpler, cheaper, and dramatically more effective. Financial experts have been recommending the same basic framework for decades, and it works. Step 1. Buy term life insurance. If you have people depending on your income, you need life insurance. But you need term life insurance, not whole life. A 20 or 30-year level term policy gives you pure, clean protection at a fraction of the cost. A healthy 30-year-old can get $500,000 of coverage for as little as $25 to $35 a month. That's it. Your family is protected, and you still have hundreds of dollars left every month to actually build wealth. Step 2. Invest the difference. Take every dollar you're saving by choosing term over whole life and put it to work in tax-advantaged accounts. Start with your employer's 401k, especially if there's a company match. That match is an instant 50% to 100% return on your money that no insurance policy can compete with. Then max out a Roth IRA every single year. Then invest in low-cost index funds that track the broader market. This simple, boring, unsexy strategy has created more everyday millionaires than any whole life insurance policy ever has or ever will. The formula is not complicated. Term plus invest equals freedom. Section: The closing truth. Look, I want to be very clear about something before we wrap up. Not every insurance agent is a bad person. Many of them genuinely believe they are helping their clients. But a system that financially rewards agents for selling the most expensive product will always produce biased advice, regardless of intentions. The problem isn't always the person. The problem is the incentive structure built around them. And your job as a consumer is to understand those incentives before you sign anything. Whole life insurance has existed for over a century, and it will continue to exist because it is an extraordinarily profitable product for the people selling it. The industry spends millions of dollars every year training agents on exactly how to handle your objections, exactly how to make you feel like you're missing out, and exactly how to close the sale before you have time to think it through. Now you know what they know. Now you can walk into that conversation with your eyes completely open. If you already own a whole life policy, don't panic. Talk to a fee-only financial advisor, someone who charges a flat fee for their advice and earns zero commission from any product they recommend. They will help you evaluate whether keeping, converting, or surrendering your policy makes the most sense for your specific situation. If this video opened your eyes, please share it with someone you care about, because somewhere in your life there is a person sitting across from an insurance agent right now, about to make a decision they'll regret for the next 20 years. Be the person who warned them first. And if you want more no-nonsense personal finance content that actually puts your interests first, subscribe. I'll see you in the next one.